The geopolitical landscape didn't just shift today, it suffered a terminal fracture. We are no longer dealing with speculation, unnamed sources, or social media rumors. This is the big one. Iranian state media has officially confirmed that Supreme Leader Ali Khamenei has been killed. The reports are clinical and devastating. The Supreme Leader reached what the state broadcaster calls martyrdom following a series of high-precision, coordinated U.S.-Israeli airstrikes. This wasn't a lone drone or a technical failure. This was a decapitation strike aimed at the very soul of the Islamic Republic's power structure. But the shockwaves didn't stop there. In a brutal display of intelligence and kinetic reach, former Iranian President Mahmoud Ahmadinejad was also killed in a separate, simultaneous strike. When you see Iranian state media and Fox News reporting the exact same reality, you know the world as we knew it on Friday is gone. We are witnessing official confirmation of the removal of two of Iran's most powerful and polarizing figures in a single window of time. For decades, analysts debated what a post-Khamenei Iran would look like, but no one truly prepared for it to happen via a direct military strike of this magnitude. The strategy behind the strike was clear: cut off the head to paralyze the body. However, in the world of asymmetric warfare, Iran is a headless hydra. Many Western observers naively thought that the death of Khamenei might lead to an immediate de-escalation, a moment of stunned silence where cooler heads might prevail. They couldn't have been more wrong. Instead of a vacuum of inaction, we are seeing a vacuum filled by pure, unadulterated retaliation. The removal of these figures has removed the red lines. There is no longer a centralized authority to negotiate with, and there is no longer a reason for the Iranian Revolutionary Guard Corps, IRGC, to hold back. This isn't just about a change in leadership, it's about the total collapse of the shadow war era. We have moved into the light of a hot, regional conflict that is rapidly metastasizing into a global economic war. As the smoke clears over Tehran, the reality is setting in. Two pillars of the Iranian state have fallen, and in their place, a storm of 165 ballistic missiles and 541 drones has been unleashed. The headless hydra is now lashing out blindly, and its first targets aren't just military, they are the very infrastructure of the global economy. This is where the story starts, but as we move into the next sections, you'll see why the death of a leader was merely the catalyst for the death of the current financial system. The moment the news of the Supreme Leader's death was confirmed, the Iranian military apparatus didn't hesitate, it accelerated. We are witnessing a saturation strike the likes of which modern warfare has rarely seen outside of a World War scenario. Since yesterday, Iran has launched a staggering 165 ballistic missiles, 2 cruise missiles, and 541 drones. Let's look at the data, because the numbers tell a story of sheer volume versus defensive capacity. While the high-tech defense umbrellas managed to intercept 152 of those ballistic missiles and destroy 56 drones, the sheer math of the swarm eventually broke through. 35 drones hit land, and 21 of those struck civilian targets just this morning. This isn't just collateral damage, this is a message. The United Arab Emirates, UAE, long considered the safe haven and the glittering financial hub of the Middle East, has been functionally turned into a war zone. This is the reality most mainstream news cycles are trying to soft-pedal, but the boots on the ground see it differently. 3 people have been killed and 58 injured citizens of various countries, caught in the crossfire of a regional meltdown. Civilian homes and properties have sustained moderate to severe damage, but the psychological damage to the safe haven status of Dubai and Abu Dhabi is permanent. But the most provocative move, the one that confirms we are in uncharted waters, was the direct targeting of the U.S. aircraft carrier Abraham Lincoln. The Iranian Revolutionary Guard Corps, IRGC, didn't hide this. They shouted it from their state media. They launched 4 ballistic missiles directly at one of the most powerful symbols of American power. Whether those missiles connected or were neutralized by the carrier's strike group defense systems is currently a matter of conflicting reports, but in the world of macro geopolitics, the intent is the event. Attacking a U.S. carrier group is an act of total war. It signals that Iran is no longer playing the proportional response game. The IRGC issued a statement that should send chills down the spine of every desk trader and oil analyst. No red lines anymore. Iran has stated clearly that it will not bow to its enemies and will continue to respond with strength. What we are seeing is a calculated maritime and aerial assault. They aren't just firing at random, they are stress testing the world's most advanced defense systems and finding the gaps. When you launch 500+ drones, you aren't looking for a 100% hit rate. You are looking to deplete the interceptor stocks of your enemy and ensure that at least 5% of your payload reaches a critical target. As the UAE's non-oil economy, specifically Dubai's trade and tourism infrastructure, reels from drone hits, The global market is beginning to realize that the stability we bought with decades of diplomacy has been sold for a handful of kinetic strikes. The U.S. Fifth Fleet, based in Bahrain, is now operating in a theater where the adversary has proven they can and will target the military-commercial nexus. This is why the red lines mattered. They were the invisible barriers that kept the global economy moving while the shadow war simmered. Now, those barriers are gone. We are in a violent negative supply shock scenario. The kinetic war in the UAE and the Persian Gulf is the direct precursor to the economic warfare that is currently manifesting in the gold and silver markets. The drones are flying, the missiles are landing, and the insurance companies are watching. This isn't just about who died in Tehran anymore. It's about the fact that the most critical energy and financial hubs in the world are now officially within the kill zone. In macroeconomics, there is a massive difference between a technical reality and a functional one. Technically, the Strait of Hormuz is open. No massive chain has been stretched across the water. No minefield has officially been declared. But functionally, the strait is frozen solid. This is the world's most critical energy choke point, a narrow strip of water where roughly 20% of global seaborne oil trade flows every single day. If that artery stops pulsing, the global economy suffers a massive stroke. Here is how the invisible blockade works. It isn't just about torpedoes. It's about war risk insurance. Shipping companies aren't gamblers. They are math-driven machines. To sail a $100 million oil tanker through a high-risk zone, you need coverage. Over the last 48 hours, the cost of that insurance has gone from a manageable $250,000 per voyage to a staggering $375,000. That is a 50% jump in overhead in a single weekend. But the cost isn't even the biggest problem, it's the availability. Insurers are beginning to refuse coverage altogether. If a ship stops being insurable, it stops sailing, period. We are currently tracking 150 tankers that have dropped anchor in open waters sitting off the coasts of major Persian Gulf producers like Saudi Arabia and Kuwait. They are refusing to move. Oil and LNG, liquid natural gas carriers, are effectively paralyzed, waiting for a signal that isn't coming. Maersk, one of the largest shipping giants on the planet, has officially suspended all transits through the Strait of Hormuz. When the big players pull out, the game is over for the rest of the fleet. This isn't just a theoretical threat. We have confirmed kinetic attacks on civilian vessels. The Skylight, a Palau-flagged oil and chemical tanker, was hit near Kasab at the very entrance of the strait. 4 crew members were injured, and 20 had to be evacuated while the ship burned. Shortly after, a second vessel, the MKD Vion, was also targeted. As I write this, 2 massive vessels are on fire near the entrance to the Gulf. This is the insurance trigger that has frozen the trade. The economic math here is terrifying. We are looking at a violent negative supply shock. Roughly 20 million barrels of oil per day are now frozen in the Gulf. But it's not just oil. Qatar is the world leader in LNG exports, and 100% of those exports pass through that same narrow strait. In an instant, a massive portion of the world's energy supply has been blocked. Brent oil prices are already trading up 8 to 10%, hovering around $80 per barrel on the weekend markets. These gains aren't being given back as the news settles. They are holding firm because the market realizes this isn't a temporary spike. This is a structural collapse of the supply chain. Many analysts are waiting for Monday's open to see if the paper markets can suppress the price, but you can't print physical oil, and you can't insure a burning tanker with a central bank press release. The Strait of Hormuz is the heart of the global energy system, and right now, the heart is stopping. The functional closure of this waterway is the single greatest threat to global GDP we have seen in our lifetime. As we move into part 4, I'm going to show you why this isn't just a choke point issue. Iran's strategy is far more sophisticated and far more dangerous than just blocking a strip of water. They are targeting the very bones of the global trade infrastructure. In the old world, military strategy focused on sea control, sinking the enemy's fleet, and controlling the waves. But Iran has flipped the script. They've realized that you don't need to sink 1,000 ships if you can incinerate the places those ships need to go. This is a calculated maritime assault targeting the critical bones of global trade, the ports. This is where the kinetic war meets the economic war, and the results are devastating. Let's look at the map. Iran didn't just hit the Strait of Hormuz. They moved down the coast to Duqm in Oman. Why Duqm? Because it was specifically built as a bypass port, a strategic exit for oil and cargo that wouldn't have to risk the narrow throat of the strait. By hitting Duqm, Iran told the world, there is no back door, there is no escape route. Then they moved on to the crown jewel of Middle Eastern logistics, Jebel Ali in Dubai. If you aren't a logistics nerd, you might not realize that Jebel Ali handles 60% of all UAE imports. It is the lungs of the Dubai economy. By striking this port with drone swarms, Iran isn't just aiming for oil. They are crippling the entire non-oil economy of the Emirates. When you hit a container terminal, you aren't just destroying boxes of electronics or clothes. You are destroying the complex, fragile, just-in-time supply chain that keeps a desert metropolis alive. The strikes continued at Mina Salman in Bahrain. This is a surgical strike at the military-commercial nexus, as this port is the home of the U.S. Fifth Fleet. By exposing the vulnerability of a port that hosts the most powerful naval force in the region, Iran is demonstrating that even the highest level of military protection cannot guarantee commercial safety. They even reached across the region to strike Haifa in Israel, a vital gateway for energy and goods. Here is the macro reality that the talking heads on TV won't tell you. You can sink a ship, but if you ignite a port, you win the economic war. Ports are the real battlegrounds because they are static, fragile, and virtually impossible to defend against modern asymmetric threats. You can put a Patriot missile battery on a coast, but a Patriot is designed to intercept high-altitude threats and ballistic missiles. It is not designed to stop a swarm of 50 low-cost, low-altitude drones worth $20,000 apiece from flying into a multi-million-dollar shipping crane. You cannot protect every crane, every fuel terminal, and every storage tank with a carrier group. This is the ultimate asymmetric play. Iran is igniting infrastructure that cannot be replaced overnight. If a crane at Jebel Ali is twisted into scrap metal by a drone hit, that terminal is out of commission for months. Multiply that by every major port in the Gulf, and you have a total repricing of the global tanker fleet overnight. Every exporter in the region is now feeling the infrastructure premium. The world's carrier diplomacy is being rendered obsolete by the drone swarm. We are seeing that while the West spent trillions on massive, expensive platforms, the adversary spent millions on ignitable targets. This is economic warfare, meeting energy warfare at the water's edge. Every Gulf exporter is now watching their lifeblood, their ability to actually move their product, be systematically dismantled. As the cranes fall and the terminals burn, the world is about to find out just how dependent we are on these tiny points on a map. In the next section, we're going to look at the importers, the nations about to take the biggest hit from this infrastructure collapse. In the world of macroeconomics, we often talk about the spot price of gold as if it were a single, immutable truth. It isn't. Usually, the Western paper markets, the COMEX, and the London Bullion Market Association, LBMA, dictate the price through the trading of digital contracts. But when the world catches fire, paper burns first. What we are seeing right now is a total separation between the price on a screen in New York and the price of a bar in your hand in the East. The signals coming out of China right now are unprecedented. Dashang Bank just issued a critical notice. If there is a significant deviation in price, leading to the depletion of accumulated gold liquidity, trading will be closed. Read between the lines. They are running out of physical metal. There is a gargantuan amount of yuan savings sitting on the sidelines, waiting for the market to open on Monday morning. People aren't looking to trade gold, they are looking to exit the fiat system entirely. This panic has pushed price discovery into what we call the dark market. While the Western exchanges were closed for the weekend, the real price of gold, the price paid in back alley deals and private transfers, touched a staggering $6,000 per ounce. That is not a typo. That is the price of desperation. When a regional war goes global and the most critical energy choke point on Earth freezes, $2,700 an ounce feels like a dream from a bygone era. But you don't have to look at the dark market to see the decoupling. Look at PAXG, the tokenized physical gold that lives on crypto rails. Because crypto never sleeps, it acts as a real-time canary in the coal mine for the traditional markets. Yesterday, PAXG hit $5,600. As I record this, it is trading around $5,400. Do the math. That is roughly $124 above Friday's spot close of $5,278. This is the premium of reality. While the traditional Western markets stay safely closed, the premium runs wild. This creates an arbitrage gap that will be impossible to ignore when the bells ring on Monday. Either the paper markets must gap up hundreds of dollars to meet the physical reality, or the physical markets will simply stop selling to the West at a discount. The data is undeniable. Informed money, the smart money that understands the implications of a functional closure of the Strait of Hormuz, values gold far higher than the Western paper contracts suggest. They know that in a world where no red lines exist, the only thing that retains value is an asset that has no counterparty risk. You can't print physical gold, and you certainly can't use a digital gold contract to buy oil from a producer who no longer trusts your currency. We are entering a phase of financial warfare education. The gap size on gold futures tonight will tell us everything we need to know. If the Shanghai premium continues to widen, it means the East has officially broken away from the Western pricing model. They are paying for the physical metal because they know the reset is no longer a conspiracy theory, it's a logistical necessity. Gold is leading the move as the ultimate safe haven, but as we're about to see in Part 6, its little brother is doing something even more explosive. Silver is no longer just a monetary metal, it's an industrial weapon that is currently in a state of terminal shortage. If you want to see where the real informed money is moving, look at Shenzhen. While Western traders were busy enjoying their weekend, the physical silver market in China didn't just move, it exploded. We are seeing a $27 premium in China's physical markets over Western paper prices. Let that sink in. That isn't a fluctuation. That is a market in total revolt against the New York and London pricing models. According to a leading Chinese commodities trading advisor, the buyback price premium between small distributors in Shenzhen shot up by almost $20 per troy ounce equivalent. This has pushed the physical silver buyback price north of $120 per ounce. Contrast that with where the Western paper spot price closed on Friday, roughly $93. Why is this happening? Because the small distributors in China, the ones who actually hold the metal, have stopped selling. They aren't looking at the charts, they are looking at their empty vaults. They are terrified of a total lack of supply. When the world's most critical energy choke point freezes, the just-in-time delivery of industrial metals becomes a fantasy. If you are a manufacturer of solar panels, EVs, or AI data center hardware, and you don't have silver, your production line stops. You don't care about the spot price on a screen in Manhattan. You care about having the physical material to keep your factory running. The weekend data across various platforms confirms this madness. IG Weekend Spot Silver, trading near $100. Hyperliquid, showing $96. Shanghai Spot, $105. Shanghai Futures, Sant Wheat Dollar. Western Spot, Friday close, $93. We are seeing a massive $15 premium on Shanghai futures and that staggering $27 premium in Shenzhen physical markets. This is the silver squeeze on steroids. Silver isn't just a monetary reset hedge, it is the industrial shortage play. Before this weekend even started, silver was already showing extreme structural strength with 10 consecutive monthly green closes. We've seen silver lease rates spiking for 6 straight days, a classic sign of a market that is desperately short of physical metal. And now, you add a regional war and a maritime blockade into the mix. The demand for silver in solar, EVs, AI data centers, 5G, and military defense hasn't stopped just because the Strait of Hormuz is closed. If anything, the military demand is about to skyrocket as missile and drone production ramps up globally. Mine supply cannot keep pace with this level of consumption, and the paper markets have been suppressing the price for so long that when the break finally happens, it won't be a gradual climb, it will be a vertical moonshot. When Western markets open tonight, the arbitrage will be impossible to ignore. If you can buy paper silver at $93, but the physical metal is trading at $120 in the East, the Western vaults will be drained within hours by anyone with a shipping container and a sense of math. This is how the system breaks. The physical buyers in Asia aren't selling at a loss just because a Western bank wants a lower price. They know what the metal is worth in a world of scarcity. The data is clear. The paper-silver regime is dead. We are moving into the era of the physical premium. In the world of macro energy, there is a list of nations that are terminal importers. These are countries with world-class industrial bases, but zero natural resources to fuel them. They rely entirely on the steady, unceasing pulse of tankers through the Strait of Hormuz. These nations account for roughly 69% to 75% of all crude flows passing through that now frozen choke point. Let's start with Japan. Japan is a modern industrial miracle built on a foundation of sand. They rely on the Strait of Hormuz for 75% of their total oil imports. Overall, Japan is nearly 100% import dependent for its primary energy. As I write this, Japanese tankers are literally turning back in the middle of the ocean. They aren't waiting for a de-escalation. They are fleeing a war zone because they know that without insurance and without a guaranteed route, a $100 million vessel is just a floating target. For Japan, this isn't a price hike, it's an existential threat to their power grid and manufacturing sector. Then we look at South Korea, another industrial titan that gets 60% of its crude through Hormuz. Their just-in-time economy is built on the assumption that the seas will always be open. That assumption died this weekend. But perhaps the most dramatic impact is being felt in India. India sources 50% of its crude imports from the Gulf states, roughly 2.6 million barrels per day. On top of that, they rely on the region for 60% of their natural gas and LNG. As fuel prices skyrocket, the Indian rupee, INR, is coming under immense, unsustainable pressure. When you have to spend significantly more of your national currency just to keep the lights on, your GDP growth doesn't just slow down, it takes a direct kinetic hit. India is facing a twin deficit nightmare that could set their development back by years. Now, let's look at China. China is technically the largest absolute buyer, taking 55% to 60% of its crude imports via the strait. However, China has been playing a much longer, much smarter game. They have significant diversification through Russian pipelines. While the rest of Asia is staring at a closed door in the Persian Gulf, China has a back door that stays open. They will still feel massive price pain. No one escapes an 8 to 10% jump in Brent oil. They can absorb the shock far better than Japan or India. This is where Iran's port strategy becomes a textbook example of asymmetric warfare. By targeting the military-commercial nexus and freezing the insurance markets, Iran has effectively held the economies of Japan, South Korea, and India hostage. You don't need to sink every ship, you just need to make the cost of shipping so high that the importers' economies collapse under their own weight. Every Gulf exporter is currently repricing their risk, but the importers are the ones who will pay the ultimate price. We are seeing a realignment of the global order in real time. The nations that didn't diversify their energy sources are now realizing that a no red lines world is a very cold place to be. As we move into the final section, we're going to bring it all home. We'll look at the Monday gap, why the physical buyers in Asia are laughing at Western paper prices, and what you need to watch when the markets open tonight. As a macro analyst, honesty is my only currency. While the headlines are screaming World War III, it is my job to give you the resistance case, the cooling off perspective, because logic must always override hype. In the next few hours, when the global futures markets open, we are going to see a gap. A gap occurs when a market opens significantly higher or lower than its previous close because of news that happened while the exchange was asleep. The resistance case suggests that weekend premiums often overstate the actual gap. We've seen this before. A geopolitical event happens, the dark markets spike, but then the big banks coordinate to slam the paper prices lower on Monday morning to fill the gap and maintain the illusion of stability. There is a chance that strikes could de-escalate, or that insurance companies might recalculate their risks if the Strait of Hormuz stabilizes. However, let's look at the facts on the ground. Iran has just declared there are no red lines anymore. Official reports confirm that airstrikes are expected to continue for days, not hours. Iran has already struck U.S. bases in 5 different countries and targeted a carrier group with ballistic missiles. Israel has explicitly stated that regime change is now the goal. The Houthis are resuming attacks in the Red Sea. This isn't a skirmish. These are sustained military operations with regime-ending objectives on both sides. While the paper markets slept, the physical markets gave us a preview of reality. When physical silver is trading $27 above Friday's close and gold is $124 higher on tokenized rails, that isn't noise. That is real-time price discovery. The arbitrage between the East and the West is becoming impossible to ignore. Physical buyers in Asia paying $120 for silver are not going to sell at a loss just because a Western bank wants to suppress the price. Underneath the smoke of the missiles, the structural deficits that were already breaking the system haven't changed, they've only been accelerated. Silver, 10 consecutive monthly green closes and a widening $27 physical premium. Gold, 7 straight record highs with central banks buying at the fastest rate in history. Industrial demand, solar, EVs, AI data centers, 5G, and the military-industrial complex cannot function without these metals. Mine supply was already failing to keep pace. Now, the supply chain is physically blocked. When the Western markets open tonight, watch these 4 indicators. The gap size. Does gold and silver jump to meet the Asian physical price, or do the banks try to slam it back down? The premium. Does the Shanghai Shenzhen premium widen past $27, or does it compress? The duration. Do the strikes continue into the midweek as Iran promised? The insurance. Does the Strait of Hormuz remain uninsurable, keeping those 150 tankers anchored in open water? The data is clear. We are no longer in a standard trading environment. We are in a period of financial warfare education. The 3 assets that matter now are gold, the monetary reset hedge, silver, the industrial shortage play, and oil, the energy that cannot be printed. Everything else is just sentiment. These 3 are the necessities of a world in conflict. As we move into this historic week, remember, The informed money has already moved. They moved while the COMEX was asleep. They moved while the insurance premiums were being hiked. They moved because they know that in a world of no red lines, your only protection is an asset you can hold, an asset that has no counterparty, and an asset the world desperately needs. Follow Miles Macro for real-time updates as the gaps open. If significant data drops, I'll be back with another deep dive. Invest with logic, not hype. The world is resetting. Make sure you're on the right side of the trade. Miles Macro, out.